And on today's show, how learning to manage AGI and MAGI can increase the money you keep. Part 2 of this week's New Tax Reduction Strategies with nationally recognized product taxation expert Ken Davis, CLU, CHFC, and CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to day 2, Ken.
Hey, Stephen.
Man, that was a great show yesterday. If you missed it, I think you should hop out back out to downtobusiness.ashbrokerage.com and check out this. We're talking all this week about taxes, and this is where you can get in front of your clients. They want help. They don't want to give any more to the U.S. government than they have to, and they want cash flow. If you can deliver, and we're talking about some of the things we can deliver on, we have to learn as advisors. We're not giving tax advice. We're not doing that, but we need to be educated and up to speed. And as Ken gave us a huge admonition yesterday, we need to start partnering with a few of our CPA friends. We can help them big time on this, and they can help us as well. So I love the partnering aspect of that. But Ken, let's talk about AGI and MAGI this whole show. But before we get there, walk me through the 3 basics that everybody's into: exemptions, deductions, and credits.
Well, the code basically devises the tax law to first include gross income. It defines what do we have to include in this formula. And it just marches down the front page and then the second page of the 1040. Gross income's at the top. Certain deductions like IRA deductions, alimony payments, stuff like that come out. And then we hit adjusted gross income at the bottom. And then we go through the second page. We get exemptions and itemized deductions and standard deduction. And tax credits, deductions, and exemptions fall under those pages in different places. Some of them fall on the front page before we get to adjusted gross income. Some fall below the line, below the AGI line. On the second page is itemized deductions. What the government has done effectively is a lot of the things that happen on itemized deductions on the second page are impacted by how high our adjusted gross income is, and then that adjusted gross income adds more items to get modified adjusted gross income, determines whether or not we get deductions or credits or exemptions. And on the front page, for instance, your IRA deduction, whether or not a contribution to an IRA is deductible or not may depend upon what your adjusted gross income is, or modified adjusted gross income.
Okay, so the old days of just saying my AGI is the story is way off.
Well, actually, the old days were pretty much what's your taxable income, and I apply my 25% tax bracket, and that's it.
And that was done.
That doesn't work. The idea of saying, gee, I only have to pay 15% cap gains, that's gone, because we find out that other items are affected by those capital gains at the full bore. Though, you know, a $10,000 cap gain, it doesn't flow through as $1,500. It flows through as $10,000. So,
well, in fact, we just had this discussion with a client. He said, hey, I am in the top bracket. I'm paying the 3.8% Obamacare issue. I have a 20% capital gain. He says, but that's still cheaper than my ordinary income tax. And I went, wait a minute, but you're taking Social Security as well. Now, Ken, walk us through this, because I think the mechanics of this, people go, I paid 20% top bracket. Why are you making a deal out of this?
Okay, well, let's go back to, and if you want to follow along, get on and do a Google for the Form 1040 and just get it on your screen, and you can walk through it better. But basically what happens is capital gains are on Schedule D. They flow through to the front page. Well, I had a $100,000 sale. I paid $60,000 for it. There's $40,000 worth of gain on Schedule D. That whole $40,000 flows to the front page. You don't cut it down by 85%. You don't just take 15% and flow it forward. The entire $40,000 goes forward. That flows down to the AGI, modified adjusted gross income, and that determines what your tax brackets are, whether or not certain deductions, credits, exemptions can still be had or they've been phased out. It determines whether you have alternative minimum tax or not. All of these things throughout the code are impacted by AGI and MAGI. So your cap gains, if you think the only impact is 15% tax, you're out of your mind. It is now affecting other things.
So my example, I had my top guy, he was paying 20.
Right.
He's at the top. But he's also taking his Social Security.
Right.
So even though he paid only 20% on your gain, the whole amount of the gain went over to the provisional income test on the Social Security calculation, and that became a ordinary income taxable event based on capital gains.
Absolutely.
Now, see, I think people are confused about this.
Well, even worse than that, Stephen, is the fact that modified adjusted gross income for a guy at his level, I can guarantee you that he's paying more in Medicare premiums. Where does Medicare premium show on your tax return? It doesn't.
Nowhere.
But Medicare premiums are determined by something off the tax return, again, called modified adjusted gross income. I mean, it's not just the tax law we have to look at. We have to look at what the tax law does to that, as well as now for Obamacare, recipients of the credits have to go through this process of MAGI as well. That's why we're saying the new tax planning has to revolve partially around adjusted gross income and modified adjusted gross income and controlling and managing what those numbers look like.
And part of that control, and we're going to be talking about this later on in the week, is tax-deferred products can really make an impact. And most people say, well, who cares? It's going to be ordinary income tax anyways. Well, I'll tell you, the delay and the power of deferral can make a big deal difference, and it might overcome some capital gain issues as well. We'll be right back in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Now, when we're talking in the first segment, I talked about capital gains and how, it sometimes impacts the provisional income test, which actually will then tax your Social Security benefit at the ordinary income tax rate. So we're doing, and as I told you yesterday, Ken, I've been playing on TurboTax. I'm becoming, Mr. Personal Self CPA here, doing my taxes, trying to figure out what works. And I've been doing several iterations, several versions to see this. And I got to tell you, there's not one way to do this. If you think that's an issue, think about this. And Ken said this on the show before. If you were to take on every single calculation to find out a married couple's possibilities on Social Security, I think you told me it was something like 81 different calculations in Social Security.
Well, actually, when you throw on the switching strategies, it gets to over 1,000, and it depends upon whether you have if you're a survivor, a widow or widower, whether you've been married before. I mean, there's all these different variables, and it can easily get over 1,000 different calculations.
We think that capital gains, especially the increase, plus the 3.8% tax, all these things, fluent Americans, the high upper middle class and affluent Americans are screaming for tax relief. Well, they really are.
And more subtle than what we've even been talking about is we're saying we had a realized, meaning we sold an asset, causing the gain to be taxed. It's not deferred anymore. What's even more subtle is the fact that should you have entered into an asset that was a capital gain asset in the first place or not? For instance, we know that with life insurance planned properly, we not only can defer, we can take tax-free distributions during lifetime, keep the policy in force till death, and avoid taxation altogether. I mean, it doesn't get any better than tax-free, folks, right? You don't get a deduction up front.
The gripe is usually the expense loads in the policy.
Well, and you and I both know how to manage those down to, 100, 150 basis points?
We can get this down. Think about this. And Kenny and I are both an aficionado on this issue because we believe in mitigating the expenses down to the TAMR regs. And if you do this correctly, you're talking about overpowering even capital gain treatment because we're talking about no tax treatment at all. And by the way, a little side note, if it's kept in force for the life of the insured, this isn't even showing up on your 1040.
Well, and you and I, this is topic for another show, but when you add in the irregular mutual funds management fees and then look at the statement of additional information and find out there's another 70 or 80 or 100 basis points on top of that, and then you have a management fee, I mean, my gosh, it doesn't, yes, it's going to take a while for the life insurance policy to get to the point where you pass that break-even point and come ahead. But there is a point long term where the cost structures in a life policy are much less than playing with managing capital assets.
Well, especially in distribution, there's no doubt about that. Ken, let's talk about, when I'm looking at capital gains, was there any kind of capital gain and loss harvesting? Because we talked about this at the end of the year. We were trying to get consumers to look at this number. I find this to be an area of complete ignorance with a few exceptions. Most IRAs that are really hip to this really are doing this already. But I want to just kind of touch base because we're in capital gain area right now. This harvesting aspect, because most people say, well, I had a really good year. I'm taking a little off the top. I'm going to have to pay capital gains. But they could have also offset some of that with some loss.
Well, there's a number of ways of dealing with this problem. What we're talking about is if you're managing your own assets, and let's say they're fully managed mutual funds, so the portfolios are turning rapidly. Well, actually, let's say we have a deferral instead. I'm sorry. We've got one asset that has deferred gains, and we have another asset that has losses, right? And we want to rework our portfolio because we're not quite as happy with these wonderful stocks that have grown so much. It's time to sell them and move on. But how do we get out without paying taxes? Well, we look in the rest of our portfolio, and I'm sorry, there's no perfect investment manager out there. There are going to be losses generally, and they should be for balance. So you look for the ones that are going to create losses, and you create enough losses so that you can now sell some of the gains that you want to get rid of these stocks and redeploy. So you try to, the game with tax harvesting is trying to balance the cap gains with the losses. And before you go down this, make sure you understand how the tax law matches up short-term capital losses and short-term capital gains, long-term capital losses, long-term capital gains, and then nets those together. There's a whole process there, and that will make a difference. So when you're doing your harvesting, understand what you're doing. Then there's the game of buying exchange-traded funds that hardly change at all, and you're just doing asset allocation, and so there really isn't any current taxation at all. There's, and you can sell some of the ETFs for gains and some for the losses and do that harvesting. And then there's actually mutual funds that are tax managed that instead of just focusing solely on getting the highest returns from trading, they keep in the back of their mind when they're doing this trading to do their own tax harvesting within the mutual fund so there isn't these dividends on 1099s.
I want to just give you an exhortation. Ken and I love this. There's several carriers that have really great what we call 1040 overlays. These overlays will go right on top of your 1040. They'll show you the power of actual tax management, how to play MAGI, try to play the modified adjusted gross, and to start adding some of the tax deferral products issues we're going to be talking about Wednesday through Friday. I want you to really think about this. This is absolutely free. Most of our carriers, my personal one, I love AXA. So I love their overlay. It's really great. If you want it, just write me and I'll be happy to give it to you. Well, that's our show for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, if you want to view any of our past episodes, just go out to downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you.